I'll make some mistakes on marketable securities, and I made them in other areas than tech.
As most of you know, Warren Buffett is one of the most successful investors of all time. He has grown his company Berkshire Hathaway into one of the largest conglomerates in the world, with investments in a wide range of industries from insurance to railroads. However, one sector Buffett has historically avoided is technology stocks. He has admitted to not understanding tech companies well and has preferred to invest in more traditional old economy businesses. But in recent years, Buffett appears to be changing his tune on tech. Let's get into the details of why Buffett believes investors need proper tech exposure, especially as we turn the corner into 2023. There are a lot of insightful and useful perspectives to unpack here from the Oracle of Omaha himself on how to approach this vital sector. Buffett first points out how over the past 20 to 30 years, American corporations have become much more profitable on average, especially in the technology arena. He highlights how when looking at benchmark indexes like the S&P 500, return on assets, margins, and earnings per dollar invested have all experienced sizable expansions compared to past decades. A major driver of this profit growth is the surging tech giants that dominate the top spots on the market cap leaderboards today. Buffett emphasizes how just the four biggest tech names, Apple, Amazon, Alphabet, and Microsoft, have a combined market value nearing $10 trillion currently. Yet these tech titans require remarkably little capital expenditure or net tangible assets to operate their highly scalable, digital data-driven business models. Contrast this with the American blue-chip behemoths of the past, which populated the Fortune 500 leaderboards that Buffett remembers studying decades ago. Back then, seeing stalwarts like General Motors and ExxonMobil dominating markets made sense because they were extremely asset and capital-intensive organizations. Their large profits were understandable given the sheer physical scope and resources needed to manufacture and distribute cars globally, run nationwide telecom systems, or drill, extract, and refine petroleum products worldwide. These old economy industries represented the pinnacle of business success for their time. But Buffett points out technology companies flip this dynamic on its head, with smart software and revolutionary tech capabilities able to be developed and deployed incredibly quickly to billions of customers at minuscule marginal cost. This means tech businesses can scale sales almost infinitely without needing large investments tied to each additional dollar of revenue. The result, as Buffett notes, is technology company business models and margins that are practically unprecedented in the history of corporate America. Their immense profit levels relative to assets required to operate, especially when factoring in their ambitions and growth rates, make them extraordinary wealth creators. For this reason, even though Buffett considers tech stocks steeply valued, their incredibly superior profit drivers justify the very high premiums investors assign. Their sheer earnings power at a mass scale makes issues of valuation mostly secondary. Another vital attribute Warren Buffett emphasizes when explaining his evolving positive stance on technology companies is the unusually strong competitive positions held by leaders like Apple, Amazon, and Alphabet. Specifically, he categorizes their advantages as not only monumentally profitable, but also extremely durable. For example, Buffett calls out Apple's control of its iOS operating system and the way it ties the iPhone, iPad, Macs, AirPods, and more into an unrivaled, tightly integrated ecosystem considered invaluable by loyal customers. This creates powerful incentives for users, developers, and partners alike to actively reinforce Apple's market dominance versus considering alternatives. Amazon's similar network effect fueled stranglehold over the rapidly growing e-commerce industry also perfectly illustrates durable competitive strengths in action. The convenience of one-click checkout, reliability of fast Prime shipping, extensive content catalogs, and recommendation algorithms have hooked hundreds of millions of customers into a tremendously sticky shopping ecosystem, proving impossible for smaller retailers to compete against. This dynamic applies across the tech sector, with platform companies like Meta and Alphabet leveraging data network effects to cement leadership in areas like digital advertising, and enterprise stalwarts like Microsoft utilizing hybrid cloud solutions to own the office in an increasingly digital workplace environment for decades to come. The core point Buffett keys into is that traditional rules of competition have warped significantly for tech juggernauts. Their business models, utilizing advanced technologies, network-based advantages, and powerful AI capabilities, have formed their durable moats, allowing them to grow mostly unencumbered by direct competition despite their massive size. The final pillar upon which Warren Buffett built his thesis for investors needing to add tech exposure today centers on innovation leadership. After freely admitting he made a mistake by largely avoiding generational tech innovators like Amazon and Google for too long, He realizes investors forgot too much upside if they sit out technical transformations and disruptions driving so much economic progress. A big reason Buffett believes these specific tech innovators became so enormously successful fundamentally ties back to the durable competitive advantages touched on previously. Their technical capabilities, ecosystem synergies, and AI innovations form such strong barriers that once they achieved certain inflection points of adoption and market leadership, runaway network effects took over, making their dominance nearly impossible to overcome. So the key shift evident in Buffett's mentality explaining the pressing need to allocate portions of investment portfolios to tech is an acceptance that even value-focused principles can result in missed opportunities if they lead to excessive skepticism, dismissal, or avoidance of disruptive innovations. Historically, one of the world's great value investors, Buffett tends to only invest in things he fully understands. As always, thank you for watching. Please subscribe for more investing content and give this video a thumbs up if you found it helpful.